Hi friends, welcome you all. Today in this lecture, we are going to discuss the major technical analysis indicators to become a successful investor or trader. One must know the different technical indicators to identify the opportunities in the market and the entry and exit point in the market, and to analyze particular stock or securities. One must know, and it is necessary to know the major indicators of the technical analysis. In this video, we are going to discuss 4 to 5 indicators, and in the next video, we have planned to discuss remaining technical analysis indicator. So, what are the there are 4 categories of the technical analysis or technical indicators. First, let us discuss what are the technical indicators. Whether you are interested in forex trading or the currency trading or commodity trading or share trading, it can be helpful to use technical analysis as part of your strategy, and this includes studying various trading indicators. What are the trading indicators? Trading indicators are mathematical calculations or simple calculations which are plotted as lines on a price chart, and can help traders to identify certain signals and trends within the market. So there are different types of trading indicators, including leading indicators and lagging indicators. A leading indicators is a forecast signal that predicts future price movement, and a lagging indicator looks at past trends and indicates momentum, past trends. So lagging indicators look back and trace the past trends of the prices of securities shares, and leading indicators, it is useful to forecast or get the signals in the future how price will move. There are 4 major basic indicators. We can classify it, or we can make the 4 categories of these indicators. That is, first is trend, momentum, volume, and volatility. So technical trading involves reviewing charts and making decisions based on the patterns and indicators. So these patterns are particular shapes and candlesticks on a chart, and can give you information about where the price is likely to go next. Indicators are additions or overlays on the charts that provide extra information through mathematical calculations on price and volume. They also tell you where the price is likely to go next. So these are the 4 categories: trend, momentum, volume, and volatility. Let us discuss one by one, and later on we are going to discuss the indicators actually. So these are the categories. These are the 4 categories under which all the indicators we can classify. First is trend. uh, Trend indicators tells you which direction the market is moving in. If there is a trend at all, there are sometimes called oscillators, because they tend to move between high and low values like a wave. So trend indicators we will discuss include parabolic SAR, moving average, convergence, divergence, that is MACD. Then next is momentum. Momentum indicator tell you how strong the trend is, and can also tell you if a reversal is going to occur. means reversal means if upward trend is going on, then when downward trend will start. So they can be useful for picking out price tops and bottoms. Momentum indicators include a relative strength index, that is RSI, stochastic, average directional index, that is ADX, etc. Next category, we can say that we can classify volume. Volume indicator tell you how volume is changing over time, how many units of bitcoins or something shares are being bought and sold over time, or security are being bought and sold over time. This is useful because when the price changes, the volume gives an indication of how strong the move is. Bullish move on high volume are more likely to be maintained than those on low volumes. So volume is very important indicator, and it tells us the price changes, indication of the movement in the prices. And last category we can make volatility. Volatility indicator tell you how much the price is changing in a given period. Volatility is a very important part of the market, and without it there is no way to make money. So the price has to move for you to make a profit. The volatility is necessary because if there is the difference between prices or the fluctuation in the prices, then only you can make a money, because the stable price movement or the stability in the price movement, which will not give the profit to the trader. So fluctuations help to trade in a different point or at a different prices, and it help to make a profit. The higher the volatility is, the faster price is changing. It tells you nothing about direction, just the range of prices. So low volatility indicates small price move, high volatility indicate big price move. High volatility also suggests that there are price inefficiencies in the market. So what is price inefficiencies? Price inefficiencies means the assets price do not accurately reflect its true value, which may occur for several reasons. Means volatility suggests that the the price of particular security or stock will stable at a particular price, but it is not at the its true value, and it will fluctuate. So it finally settled down on a true value, but now it is around the value, true value. So it can we can call it volatility. There are 10 in this particular slide, the base trading technical indicators I have taken. So these are the 10 base trading technical indicators mostly used by the traders or technical analysts. First is moving averages, that is MA, exponential moving averages, EMA, then stochastic oscillator, moving average, convergence and divergence, popularly known as MACD, Bollinger Bands, relative strength index, that is RSI, Fibonacci retracement, then Ichimoku cloud, standard deviation, super trend, and average directional index. So these are the best trading technical indicators. It's depend on the technical analyst. Some may have a different view about these indicators, but generally these are the most useful trading indicators, technical indicators. So let us start with moving averages, that is called MA. The aim of all moving averages is to establish the direction in which the price of a security is moving based on the past prices. So moving averages identify the direction of a current price trend on the basis of past prices, or the trend or the direction of past prices of particular security or share, without the interference of shorter term price spikes. Means the moving averages do not take into the account the interferences of short term price spikes. Means if the price is fluctuating more in the short term, then the moving averages exclude it, and it takes the whole past trend, and on the basis of that it tells us the uh, current price trend. The moving average indicator combines price point of a financial instrument over a specified time frame and divide it by the number of data point to present a single trend line. Means it takes different past data points and present a single trend line which excludes the interferences of short-term price fluctuations. The data used depend on the length of the moving averages. For example, 200 days moving average requires 200 days of data. By using the moving average indicator, you can study levels of supports and resistance, and the see previous price action. This means you can also determine possible future pattern. So based on the past price trend, you can decide, or you can determine possible future patterns. You can identify the support and resistance. For example, if you take the example of State Bank of India's share price, then you will find that the State Bank of India's share take the support at a very low level at 150 rupees, and below that it will not it will take the support, and the if you check the data, then you will find many times State Bank of India's share taken the support at 150 rupees. So like that you can identify the support level and resistance levels on the basis of moving averages. So here I have shown the moving averages. This is the 50 days simple moving average. So you can see the fluctuations around the line. So line excludes the fluctuations in the prices and just take the average of that fluctuation. So in the short term fluctuations of prices excluded, and the average trend line taken here. So it is called the moving average. Now you can see the different moving averages, like 200 days moving average, 50 days moving average, then 100 days moving average, like that. So according to that, trend line is constructed. So here you can see the fluctuations, the short-term fluctuations are excluded, and the average trend line is taken. When we take the 200 days moving average, then we take the 200 data points to construct the line. It is already given in the Dmat account, the software of broker company. So you have to get it ready-made, and it is not required to calculate manually. You have to just set moving average in the where we set the chart. Now next is exponential moving average, that is EMA. EMA is another form of moving average. Unlike the simple moving average, it was the simple moving average. Now it is the exponential moving average. So exponential moving average, it places a greater weight on recent data point. So what is the quality of exponential moving average? It places the greater weight, or it gives the greater weight on the recent data point, making data more responsive to new information. When used with other indicators, exponential moving average can help traders confirm how the price of an asset or security changes over a certain period of time. So what is the use of exponential moving averages? It helps the traders confirm how the price of an asset or security changes over a certain period of time. Means it takes into account the past trends of price fluctuations and giving more weight on the recent data points, uh, in contrast to the moving averages, simple moving averages. In a simple moving averages, the equal weight assigned to all the data points, but here in the exponential moving average, the recent data points gets the more weight, and making data more responsive to the new information. The most popular exponential moving averages are 12 and 26 days EMAs for short term averages, and for a long term trade indicator 50 and 200 days EMAs are used. So these are the exponential moving averages, EMA. Here you can see the exponential moving average reacts quicker to the reverse in trend. So compared to the simple moving average, the exponential moving average uh, reacts quickly. So this is the benefit of exponential moving average. uh, Exponential moving average shows the upward trend faster than does the simple moving average. So uh, it is uh, it gives the greater weight to the recent data point, so it reflect more quickly what is happening in the uh, past trend line than simple moving averages. So this is the benefit of exponential moving averages. So this is the daily chart of eBay share price. Next indicator is stochastic oscillator. The stochastic indicator, this is a momentum indicator and can be used to find where a trend might be ending. So it is like a RSI. So it is used to determine when an asset is overbought or oversold. It's made up of two lines plotted on a separate chart. So stochastic can help you to pick an entry point and get into a trend at the very beginning. Uh, the stochastic moves between uh, 0 to 100, and when the stochastic line are above 80, the market is overbought and a downtrend is likely to follow. Means it can take the downtrend after the overbought zone. When oscillator reaches at the above 80, and when the stochastic lines are below 20, it indicates that the market is oversold and an upward trend is likely to follow. Means when stock or share price decreasing, then at a particular if the stochastic line are below 20, then it indicate that the market in a oversold zone, and it can reverse and start rising, or it can take a upward trend. So it is the stochastic oscillator. So here you can see uh, the stochastic indicates overbought market here at the point, And if you see at the bottom there are two lines, that is stochastic line is there, and if you see it is above the 80, and it indicates the overbought market, means it indicates that the market can follow downward trends, and actually it is followed. And if you see after the overbought point in the candlestick chart above, the candles the trend started, downward trend started, and price decreased. See the next trend, that is the oversold zone. If you see here, the stochastic at below 20 point, and from that point this security started rising, and if you see the candlestick chart, then you will find that the upward trend started. So like a RSI, here you can identify overbought and oversold zones. The same caveats as RSI apply here when trying to get into trends early. There will be many fake outs, so you should be prepared with stop losses in case the market doesn't go your way. uh, as always, use the indicator to give you an idea of where the market is likely to go, and don't bet your house on it, though good risk management prevails. Means, what is the meaning of this statement is, you should use all other indicator with the stochastic oscillator like RSI. If share in the overbought zone, and if good fundamentals and good news about that particular security is there, then it may not take the downward trends. It can go up, or it will continue the upward trend even if it is at the overbought zone. And same thing can happen if the fundamentals and the bad news is there about the particular stock, then even if it is at the oversold zone or area, it can continue downward trends. So you should use all other indicators with the stochastic oscillator like RSI. So this is the limitation of stochastic oscillator. Next is MACD, moving average conversion and divergence. It is called MACD, and MACD is the leading indicator, and it is very famous among the traders. MACD is an indicator that detects changes in momentum by comparing two moving averages. So here two moving averages taken. It can help traders identify possible buy and sell opportunities around support and resistance level. So conversion means that two moving averages are coming together, while divergence means that they are moving away from each other. If moving averages are converging, it means momentum is decreasing, whereas if the moving averages are diverging, momentum is increasing. So I will explain in a detail when we will discuss. This is a trade indicator and consists of a fast line, one fast line and one slow line, and a histogram. So you will get clarification, or you will get a clear idea when you will see the graph. The inputs for this indicator are a faster moving averages, slower moving averages. uh, Here we can see that at the bottom you will see the blue line at the bottom is the MACD. What is MACD? MACD is the moving averages of 26 days. If we take the days, uh, it is subtracted from the 12 days moving averages, So it is the MACD, which here you can take the hours also. So the famous uh, uh, in the time period we choose for the MACD is 12, 26 and 9. So 12 we subtract or we minus 26 days moving average or 26 hours moving average from the 12 days moving average or 12 hours moving average, and it is that is blue line MACD. It is called blue line, and it is also called the fast line because it moves, uh, it decreases faster than signal line, and it is increases more than uh, faster than signal line. So what is signal line? Signal line is red color line, and it is the 9 days moving average, or it is a 9 uh, periods, 9 hours moving average, and it is slow line. So when the difference between these lines increases, means when the blue line is above the signal line, it indicates that the price will rise. Here take the point in around 2016 that the both line cross over it to each other. Blue line intersect from below and go up from then signal line, and green histogram created here. What is the meaning of this crossover? When blue line crosses the signal line, it means, and it is above the zero line, then it shows the upward trend or strength in the stock, means the price of the stock will go up. And when the blue line crosses the signal line from the above, and red histograms minus histograms below zero histograms created, then it shows the weakness in the stock price. So MACD, why MACD is leading indicator? Because it tells us before price movement what will happen. It tells us before the price movement. Suppose the MACD line increases more than, or it is crosses from below and increases above the signal line, and the divergence means the distance between two lines increases, and the histogram created more than zero line, so it indicates the price of stock will increase. And if the MACD line, that is blue line, crossing signal line from the above and it is going down zero line, at the zero line histogram is zero, means there is no bars histograms, and if the blue line crosses above the MACD line, that is blue line, intersect the signal line from the above and it decreases below zero, then it shows the stock price will correct or stock price will decrease. So I think you got something idea. I will prepare a separate video on the MACD. In that I will I will focus only on the MACD. So the use of MACD is to forecast what will happen to the stock of the price of stock. So here you can see the convergence and divergence. When these two lines come together, it is called convergence, and when these two lines are the distance between two lines increasing, then it is called divergence. So if the divergence means histograms, the distance between these two lines above zero line increasing, and blue line, that is MACD line, is the above signal line, then the increase in the stock price will happen. And if the distance, that is divergence between two lines below the zero line increases, and the MACD line, that is blue line, is below signal line, then it shows that the price of a particular stock will decrease. Then next is relative strength index. Relative strength index, already I have posted one videos on this relative strength index. It is like a oscillator. Relative strength index moves between 0 and 100. So when what is the objective of using RSI, that is relative strength index? It shows the overbought and oversold area. Uh, it shows the overbought and oversold area. So here you can see when the RSI is below 30, it shows the oversold area. In the first point you can observe, and at the second point you can observe that at the 81 RSI, that is when RSI more than 70, it shows the overbought area. So overbought area and oversold area shown by the RSI, and RSI is used to identify the overbought and oversold area. When RSI at below 30, it indicates that the selling pressure is there, oversold area is there, and it can take upward trend. And when RSI at the 81, then it shows the overbought area, and the price can decrease, or the share price or security price can correct, or it will take the downward trend. So friends, these are the some technical indicators. In the next video I am going to discuss remaining all other indicators which I have discussed earlier in the earlier slides. So friends, thanks for watching. Write your name in the comment box. If you have any problem, questions, or any clarifications, then you can message me or you can call me. And if you want any extra readings, then also you can call me. Thanks for watching. See you in the next lecture.